Hi everyone, this is Jason Burack of Wall Street for Main Street. Normally I'm not going to do videos every day, but we're going to make an exception today because I got emails and messages through social media from listeners who wanted an update on the European banking system post their stress tests. So we're going to talk about that in this short video. This video is, these short videos for the most part are totally unscripted, so these are off the cuff, me, just talking about current events that I think are important to you guys and sharing them with you in links. So just bear with me in terms of that. So right now, I talked about this in a prior video. Global central banks are all in on QE, 180 billion per month. If you run the numbers with the calculator here, 180 billion times 12. So on an annualized rate, that's over $2 trillion, 2.1 trillion that central banks are putting into asset markets and stabilize the banking system, and the over-the-counter derivatives market, which is over 1 quadrillion. They're trying to put that much liquidity in just to buy themselves time. So let's go through some of the stories that I think are important. A couple of them are from Zero Hedge. One was from Mish, and the other one was from Rogue Money, which I guess is V's site. I saw someone on Facebook post that story. So let's talk about this story first. Okay, so I think one of the main reasons why the European banking system, the European banking authorities tried to do the stress test was to knock the bank stocks back up. And if you look at the chart here for European bank stocks prior to the stress test, they stopped going down. Obviously, there was market manipulation. I talked about this in my SGT report interview. To slow down how quickly bank stocks were falling. And then the stress test was done in hopes of knocking the bank stocks back up. So if some of the bank stocks, European banks, actually did well in the stress test, they could sell more shares and dilute. But that's not what happened. So look at this chart here. Stress test, nope, started going right back down again. Credit Suisse was down since the stress test 15% already. And Commerzbank, which is German, Deutsche Bank, this chart here is showing that they're predicting that Deutsche Bank is going to end up like Lehman Brothers. That's very similar charts. Obviously, there's some differences here, a few places on the chart, but it's starting to look like, they can only slow down the collapse in Deutsche Bank. Obviously, I've said in past videos, Deutsche Bank's going to either have to be nationalized, or the Federal Reserve's going to have to bail it out, or they're going to break the bank up into pieces and the German taxpayer is going to be on the hook. It's just a disaster. It's one giant fustercluck. It is a black hole, Deutsche Bank, because unlike some of the larger banks that have more assets like JP Morgan and things like that, Deutsche Bank's balance sheet is now in peril, and their derivatives exposure relative to their amount of assets is just disgustingly large. They have an enormous amount of derivatives exposure, tens of trillions of dollars, and they don't have the assets to anywhere forgive that. So, the Italian banks here in this article talking about that. So the stress test obviously has failed. You can look through these articles and see the bank stocks are down. Some of the largest ones are the Italian banks that are down the most in terms of percentage change since the stress test. Another Zero Hedge article on this. So the stress test backfired. I said before the stress test was happening that it would basically be phony. I think one of the main reasons why is because, they're not going to run the numbers on the stress test and saying, well, what happens if all of our assets drop 50%, or 50% of our assets go to zero, or 30% of our assets are wiped out, in the next week or two. So they're not going to run those types of things, which is the type of black swan events that basically happened in 2008. And we're fully capable of that because of the leverage in the banking system. There was a listener question about what's the difference between a zombie bank in Japan and what's the difference between a zombie bank in the United States or a zombie bank in Europe. Well, the difference is the amount of leverage. So there's different degrees of zombie banks. The ones in Japan didn't start leveraging 40 to 1 or 60 to 1 like American banks were prior to the 2008 crisis. Bear Stearns, I think, was over 60 to 1. Lehman Brothers, I believe, was over 40 to 1. Maybe that could be reversed, but they were both like two of the highest leveraged banks, and Deutsche Bank was super high. So, we're in a situation where a lot of the European banks have counterparty risk. Deutsche Bank is holding a lot of Italian bank bonds right now. So those bonds could potentially go to zero. And in Deutsche Bank's the assets that they were counting on, they have then counterparty problems as well. So let's get to the Mish article. Mish is just talking about how, the Italian banks right now and how the stress test has failed. And one of the things Mish is pointing out is that only 5 billion euros was given to fix over 360 billion euros in non-performing loans. Does that make any sense to you? Mish says no rational person believes that, and the market doesn't either. So it's just, I don't even know why they did the stress test. Maybe they were trying to buy themselves another week or two. I think they were trying to get the bank stocks up, 10, 15, 20% in hopes that the banks could then issue more shares, because I think everyone and their brother knows a lot of these European banks, if they're not all nationalized or bailed out, that they're going to have to do immediate equity capital raises. And you can't really do an equity capital raise if your stock price is already down 80, 90% or more. You just can't do it. Most of the CFOs in these bank companies, they'll say not to, maybe to save their jobs, they'll do it. It's putting a lipstick on a pig. There's tons of sayings on Wall Street for that. It's polishing a turd. They say funny sayings like that. It's total desperation move. If your stock price is already down 80 or 90%, people know things are bad and you're trying to come in with equity. It's the things only truly desperate companies do right before bankruptcy, just to delay bankruptcy a little bit longer. So let's get to this article from roguemoney.net very quickly. They say that only 4 major central banks are printing over 1 trillion every 6 months, so that puts things in perspective. The European Banking Authority, or EBA, tested 51 lenders. I don't think the lenders were that good. Deutsche Bank, the lenders didn't really pass the bars. Obviously, we know that the bars were going to be very, very low bars because they want to inspire confidence. Keyword con, C-O-N, as in con game, because that's what the banks are at this point. They're a shell game, a con game. And, Deutsche Bank had really, really bad earnings. I think their earnings were down almost 100%. And if you looked at a mainstream article on Deutsche Bank, they're like, oh, the company is transitioning. Oh, they had to eat this debt and write off all this asset, and they had to sell shares because the company is transitioning to a much better bank over the long term. I literally read an article like that on CNBC right after Deutsche Bank earnings. I was giggling the whole time. So if you want to learn more about the European bank stress tests, you should read these 4 or 5 articles that I'm going to link for you guys. But basically, though, I think it was just a facade. It was an illusion with these stress tests. They're not going to run them nearly as thoroughly as they should. They're not going to say, well, what happens if the bank balance sheet, if the assets were to drop 50% or more in the next week or month? They're just not going to do it. So, yeah, guys, I think the European banking crisis, it is going to get worse before it gets better. The Federal Reserve at some point is probably the main guy that's going to have to step in. The European Central Bank is, with their asset purchase program, printing over 80 billion euros per month. That is nowhere near enough, considering the over-the-counter derivatives exposure for some of these banks is in the tens of trillions of dollars. So, guys, be careful. If you're a European listener and you have a lot of money in a European bank, be very, very careful. I would start looking at... It was called BitGold. Now they've transitioned to Gold Money. You can easily open an account there, and that's one of the ways to get. You can get a gold-backed debit card, and it can easily convert and do your purchases there. There are a lot of other ways besides to buy physical gold and silver. But yeah, I wouldn't have a lot of cash in a European bank right now. It looks like the European banking crisis is getting worse. The stress test was a joke. And it looks like the next major banking crisis is going to start in Europe, and it's going to start spreading after that.